America has crossed a deeply unsettling threshold. The average citizen carries over $15,000 in personal debt, while national debt has skyrocketed to $38 trillion. This isn't temporary economic fluctuation, it's structural collapse. Households, banks, and government are sinking simultaneously. Part 1. The historic breakthrough in personal debt. The real meaning of $15,000. Americans now carry over $15,000 per capita in personal debt, marking a historic turning point. Households are no longer financing opportunity. They're financing basic survival. This debt comprises multiple layers. Mortgages, still the largest share. Home equity loans surged 7.2% year over year. Credit card debt grew 3.12% over 12 months, rates hitting 22 to 28%. Auto loans, average balance approaching $25,000. Student loans, total nearing $1.77 trillion. The critical issue: Americans' monthly debt payments now exceed $1,237, equivalent to adding a second rent payment. Worse still, debt is growing faster than it's being paid down, even adjusted for wage growth. People are being mathematically forced into a debt trap by cost structures. Debt shifts from cyclical to compounding. U.S. consumer debt has breached $17.5 trillion, even as inflation erodes purchasing power and reduces real disposable income. This means debt is no longer cyclical. It's continuously compounding. Part 2. The stock market's fragile bubble. Valuation extremes under AI narrative. 2025 stock valuations approach 1929 peaks, but risk concentration far exceeds that era. A handful of tech giants, Magnificent Seven, occupy nearly 30% of S&P 500 market cap, amplifying systemic risk exponentially. Markets are built around a single technology narrative, artificial intelligence, but profitability hasn't materialized. Once earnings disappoint even slightly, automated trading systems activate instantly, transforming mild corrections into cascading collapses. Insiders are exiting. Corporate executives and institutional investors are dumping stock on massive scale. These decision-makers with direct access to profit pipelines are choosing to cash out, signaling severe divergence between surface narrative and internal expectations. Their exits remove the market's most steadfast buying support. Part 3. Real estate's ticking time bomb. Residential market. 50% overvaluation. Residential prices run about 50% above long-term trends, far exceeding 2008 peaks. With mortgage rates hovering at 7%, buying a median-priced home requires nearly $120,000 annual income, far beyond most Americans' reach. Commercial real estate, mathematical impossibility. Remote work permanently altered office building demand. Nationwide vacancy rates approaching 45%. More lethal, over $2 trillion in commercial real estate mortgages must refinance at 7 to 9% rates, when these buildings originally financed at just 3%. A building barely covering operating costs under old financing conditions can't survive under new ones. This isn't cyclical downturn. It's mathematical imbalance forcing owners to choose between operating at losses or complete abandonment. When defaults begin, losses transfer to bank balance sheets holding these mortgages. Building valuations dropping 40 to 60% render many loans unrecoverable, bank capital buffers rapidly deteriorating. Part 4. Government debt and bond markets. The $38 trillion fiscal trap. Federal debt has breached $38 trillion, debt to GDP ratio approaching 125%, levels historically associated with fiscal distress, not stability. Government now pays over $1.2 trillion annually in interest, exceeding the entire defense budget. As debt refinances at higher yields, interest burden grows mechanically without providing any economic output. Bond markets no longer a safe haven. Traditionally, when stocks and real estate destabilize, the financial system rotates into treasuries for safety. But in 2025, this escape route has closed. Bond markets are no longer refuge. They're detonation points. Treasury supply surges, but demand hasn't kept pace. Foreign holdings stagnate. Domestic buyers constrained by their own balance sheet pressures. When supply grows faster than demand, bond prices fall and yields rise. creating a feedback loop accelerating crisis. Part 5. Crisis beyond historical precedent. 1929 plus 2008 amplified. 1929 comparison. That era's P/E ratio peaked at 33. Today approaches this level, but capital concentration makes risk far exceed that time. 2008 comparison. That crisis mainly limited to housing and mortgage-backed securities, while 2025 has layered leverage across nearly every financial domain. More critical is government's structural position. Great Depression era. Federal debt was controllable, could deploy stimulus measures. 2008. Debt at about 67% of GDP, allowing multi-trillion-dollar intervention. 2025. Debt hits $38 trillion, nearly 125% of GDP, completely losing flexibility. Government that once acted as stabilizing force is now itself a primary source of instability. Part 6. The Fed's empty toolbox. Triple constraint. Interest rate dilemma. Can't drastically cut rates without reigniting inflation, but maintaining high rates intensifies pressures on housing, corporate credit, and government refinancing. Balance sheet limits. Fed holds over $7 trillion in assets. Further expansion confirms bond market's worst fear, government fiscal dependence on money creation rather than sustainable revenue. Political constraints. Public has endured years of inflation. Repeating same expansionary policies would trigger backlash or legislative intervention. These constraints converge at the worst moment. Liquidity-dependent markets can't count on rapid easing. Debt-dependent sectors can't rely on cheap refinancing. Government itself can't depend on the central bank to paper over structural deficits. Part 7. Banking systems chain reaction. Commercial real estate exposure. Banks hold massive loans tied to office buildings, retail spaces, and hotels. When over $2 trillion in commercial real estate loans must refinance at 2 to 3 times original rates, the math immediately fails. Silicon Valley Bank, Signature Bank, and First Republic's collapses were warnings, not anomalies. Same structural fragility exists across dozens of institutions that never rebuilt adequate buffers during low-rate periods. FDIC's capacity limits. Federal Deposit Insurance Fund holds about $125 billion, yet guarantees over $10 trillion in nationwide deposits. Just a few mid-sized bank failures could drain the entire fund. Any cluster collapse is mathematically unmanageable. Part 8. Consumer vulnerability. What debt data reveals? Credit card debt breaches $1.1 trillion, all-time high. Rates exceeding 21%, transforming ordinary borrowing into long-term financial strain. Auto loan average monthly payment exceeds $740, terms stretched to 84 months. About 7.5% of borrowers over 90 days delinquent. Job market deterioration. Unemployment climbed from 3.4% to over 4%. According to the Claudia Somm rule, when unemployment rises 0.5 percentage points above recent lows, it signals recession, and current levels approach this threshold. Once mass layoffs begin, unemployment accelerates across multiple industries, reinforcing consumption spending decline. Part 9. The mechanism of collapse. Trigger can be any event. Major tech company earnings miss. Regional bank announces unexpected losses. Failed bond auction. Geopolitical escalation. The specific cause is secondary. What matters? Underlying conditions are already unstable. Cascading effects. Stock market flash crash. Single disappointment in Magnificent Seven can erase trillions in market cap within days. Margin calls. Forced liquidations accelerate decline. Bond market panic. Rising yields push up all borrowing costs. Real estate freeze. Buyers vanish. Transaction volumes collapse. Bank credit contraction. Businesses lose operating capital, begin layoffs. Unemployment spike. Climbs from 4% to 7 to 10%, removing hundreds of billions in consumer spending. Corporate earnings decline, reinforces market downturn. Conclusion, not recession, but restructuring. This collapse's consequence isn't typical economic recession, it's economic restructuring. Retirement accounts plunge 60 to 70%, obliterating decades of savings. Millions postpone retirement indefinitely. Real estate slump traps owners, can't sell without absorbing losses. Younger generations enter labor markets with fewer opportunities, lower wages. Small business mass extinction, credit dries up. Corporate consolidation spreads, reducing competition and economic vitality. Recovery takes years, provided policy tools are robust. When tools are exhausted, recovery extends into decades. This is the defining consequence of the coming collapse. Not just market crash, but restructuring of American economic life that alters opportunity, wealth, and stability for an entire generation.